Hello everyone, welcome back to my channel. So this video marks the end of the week number 69 in this road to 100k realized return challenge. And first of all, I want to unpack or to disclose rather that because there were no maintenance going on today from the side of interactive brokers, we managed to do this video a bit earlier in the day, unlike the past few weeks. So all good. I suppose this is the return to the normal routine of posting the videos uh, to close the each week of this challenge. But moving on to the main course here, and this week was yet another extremely volatile week. We have a lot of information to unpack here, and so yeah, let's jump in. So this was yet another, because of also its volatility, a very also a negative week for the market in general, and we are on course to the worst month, or rather the first month of losses in the market since April, because of the so-called Liberation Day back in April. And this is the worst November since '08, when we were at the height of the great financial crisis. Just for you guys to have an idea of, yeah, things are not looking rosy at this point in the market. The market, and looking here at the Qs again, we are going to focus exclusively on the Qs because we had no exposure to IWM this week. And honestly, the week began with high hopes. We had basically a good development in the at the beginning of the week, because the markets start coming up, recovering from this big gap to coming from last week and to the beginning of this week. But then it was pretty much downhill most of the way. And we must also keep in mind that most of the trading on the 17th and on the 18th, so Monday and Tuesday, was not really that material, because all eyes were on the biggest highlights of this week, which were the Nvidia earnings on Wednesday, so on the 19th, and also on the jobs report on Thursday. And so these were basically the clues or the information that the market was waiting for. And so basically the markets just chopped around during Monday and Tuesday. And when the news came that Nvidia, and I'm going to show here, yeah, so Nvidia, basically they delivered yet another stellar quarter earnings. Basically they beat, and by quite some margin, both the earnings and the revenue, and they delivered also a very strong guidance for this quarter. So they expect revenue to rise even higher for this current quarter, so fourth quarter. And this also is another beat, if it happens, is another beat of the revenue expected by the analysts. So this put some under some doubt the current news, or the current expectation that is going on in the market, that we are in an AI bubble. And so things continue to go well for the biggest company in the world and the darling of the stock market. And because of this, the market had a good reaction on after the earnings were released. And this is basically what happened. I'm going to put here the our local time, and so for Central Europe. And this was a very significant rise here. However, and yes, so Yeah, this is where we stand at the moment. Yes, this is where the earnings were at the point at which the earnings were released, and because of the earnings release, we had this considerable gap here, which was of course a positive development. However, right around this time was a time in which the jobs report was released, and uh, oddly so, it was a very positive jobs report. Keep in mind for September, because the economy added 119,000 jobs, considering and looking here where we were, considering that the market was expecting 50,000. This was more than double the jobs that were created, even though, of course, the unemployment rate creeped up a little bit by 0.1 percentage points. But still, this is still pretty much, and given the historic unemployment rate of the United States, this is pretty much almost full employment situation going on in the economy. And not only that, the jobless claims were also under the expected figures, not by a long shot, but still a bit below. Now, I want to make a remark about this thing because uh, because we are currently in November and this jobs report was per September, and keep in mind that this information is collected based also on surveys. Uh, First of all, this data can also suffer a bit from inaccuracies because it depends on the employers um, that take the time to fill out the reports, and also this is not the most recent data point that we could potentially have. This is already lagging data, 2 months. This is data that is already lagging for 2 months, and central banks, and because this has an implication on the interest rate that the Fed will set, central banks should have a forward-looking uh, um, a forward-looking view on whether they decide to keep or increase or decrease interest rates. So even though it's a very positive number, I would not put too much faith into this number to make an assessment of the health of the job market in the US or even of the economy for that matter. But because of this, and also because of the Fed speak that occurred during this day, in which some of the Fed members spoke, and not Stephen Miran, because Stephen Miran is very pro-Trump and so he's pro interest rate cuts. He has a very dovish stance on interest rates. But the other Fed speak that took place was about the Fed members were very reluctant that an interest rate cut would happen on the by the next meeting, which will take place on December 9th and the 10th. And because of that, this was the result. So the combination of a strong job market performance on September, coupled with an increased reluctance on a further interest rate cut in December, had this impact in the market. Markets came like a complete roller coaster, came absolutely plunging down all the way until the end of the day. And keep in mind, I checked, of course, other news pieces, and there were only eight times, and I can show, for example, here the situation of Nvidia as well, because Nvidia suffered the same fate as this one in the market. Let's show it here. So, and yes, this is exactly what happened, and this is something that only occurred 8 times, so 8 trading days since 1957. So in almost 70 years, it only happened in a market, an index rising this much. And looking back again to the cues, rising by this magnitude so much at the beginning of the day, and then plunging down this way. And so this is an extremely dramatic fall, and it tells volumes about how important it is for investors to keep interest rates coming down. Uh, Now the situation is very different than what it is here today in the chart for the Fed funds futures. But for the probabilities of the Fed fund futures in terms of interest rates, but at that point, there were only 33% of bets that there would be an interest rate cut, and there were about 66%, so 2 out of 3 chances that rates would remain the same. Now, why this situation is reversed now from the day before, so Thursday, why this now it looks like this? Because on Friday we had some more Fed speak, and I can't recall which member spoke, but told that it was perfectly feasible. It was probable, and he supports it, that there would be an interest rate cut on the coming meeting. And what was the impact on the market? Here is this one. On Friday, even though it started a little bit more subdued in the beginning, but just the markets finished higher and mostly positive. IWM even went even higher. I believe it went more than 2%, if I'm not mistaken, just on Friday. And yes, this was exactly what happened, more than 2%. And because of also of this last Fed speak on Friday, basically the probabilities reverse themselves. Now it's a little bit more than 2 out of 3 chances of a interest rate cuts, and a little bit less than 1/3 that interest rates remain the same. And this tells you volumes and shows very clearly how important it is for the market to keep rising, that interest rates continue to come down. I know that there are some very large implications also in terms of the debt and the current deficit that the US government is running. And it's important for them that interest rates keep coming down to lower the cost of the debt, because the interest payments are becoming very, very large, and are taking a bigger and bigger chunk of the expenses of the government. But still, this is something that the markets expect to keep happening, and they will react negatively whenever there is some sort of resistance for this development to take place. Now, other topics that are important also, besides this situation of volatility and instability in the markets, the dollar kept pretty stable against the euro, and showing here, just last week, it even managed to gain some value against the euro. So this also is good for us, because we are exposed to the dollar, since the options and the shares that we have are quoted in US dollars. So this is a positive development for us. And I think, yeah, this is for the most part all the main points that I want to touch upon. Now, when it comes to our trades, this was yet another week which was very weak by our previous standards. As you can see here, we managed to accrue this week a little bit under $390 for this week, which is not nearly as good. Currently, we managed to bring the cost basis, because of the premiums we have been collected, of our triple Q shares almost to 625. So potentially we can even sell these shares at 626, and we still would come out with a profit, because the capital loss would be more than offset by the premiums that we already collected. But there are some reasons. There is a big reason for why I keep selling calls at the 630 price, 630 strike price. It's very easy to show you the reason why, because as you can imagine, we have to go way, way, way down in the option chain to find these options. All right, and so what's happening is basically, and showing you here the one that we are currently exposed, which is a 630 call, and you'll be, I suppose it will show up. Yes, and it does. As you can see here, and this is the data that was available at the end of the trading day yesterday on Friday. There are no difference in premiums for for these for these options. Why is that? Because these options are very, very deep out of the money. They are very, very far away from the stock price, the current stock price, and so because of that, the delta of these options, so the the effect of stock price changes in the option price, the premiums, is almost zero. It's irrelevant because the options are very, very much out of the money. If the stock was, for example, at 610, 615, probably would start to see a little bit of a discrepancy because the deltas would be higher. And so for each movement of $1 of the stock, we would see some movement in the premiums, and especially for the options which are closer. The closer the stock is to the closer the strike is to the current stock price, the bigger is the delta, and so the bigger is the sensitivity. But because these are so far away from the money, their delta is almost zero, and so they basically don't move even if the price moves $1 up or $1 down. And so it makes no sense for us to be exposed to a potential capital loss just to collect 1 cent more per share in premium. So we might as well, and for example, in this case, it's completely the same whether we sell a 627 strike or a 629 strike. So uh, we might as well continue to do this. And for example, if this was the option chain available for us, it is the same thing if we sell at 630 or a 635. So we would always sell a 635 because we still have the potential capital gain, which of course is extremely unlikely given the difference in price at the strike. But it would never make sense in this setup to choose this one. We would always choose this one because we get the same premium as in the 630, but we have a higher strike price, so a higher potential capital gain. And so we continue to do things this way. It makes no sense for us to go lower the option strike. So far, of course, if we start to see some bigger differences between the strikes, of course, we may consider this. But so far, the distance is so great. I think between 630 and 692, it should be about 6%, if I'm not mistaken. So 630 divided by 692, yeah, it's 6.4%. So it's, yeah, I was not too far off. So it's about 6.4%, and so it makes no sense for us to do it any different. Now, when it comes to the XLF, oh, one last thing. As you can see here, we sold this option, these Q's options here yesterday, and they expire the next week on the 28th, so next Friday. We received 11 cents in premium, and we can show this here. Yeah, here they are. So for these calls, we received 11 cents in premium. So we sold these options yesterday on Friday, and look at the price they are already selling at this point, despite despite the stock having risen during the day. So The stock rose in price, so the premiums of the call should increase, right? Because that's how the delta of a call option works. The higher the as the stock increases, the value of the call still continues to go up, but because the delta is almost meaningless at this point, the other Greeks of the option dominated the effect on the price, or rather on the premium. And because of the loss of 1 day of theta, worth of theta, basically because nothing else changed except for the decrease in volatility. So this would also benefit the our this movement. But basically, and let's show here. I also opened here the VIX, and basically because of the VIX is the volatility index. It came down, so when it comes down, the premiums also come down, and we also lost 1 day worth of theta in the call. So this movement between 11 cents and 2 cents was basically the effect of the fall in the vega, in the volatility Greek, and of the theta, the passage of time. And these two effects completely overwhelmed the increase in delta, or the increase in premium that would have come from the increase in the price of the shares. All right, so just for you to see how these dynamics work and what was the actual effect for this to happen. Now, with this out of the way, moving on to the XLF. Yeah, the stock continues to trade around 52, 51 and a half. And so we got the enough funds to sell another put on the XLF, and we did it, if the memory serves me right, on Friday. And yes, that's exactly what happened. This was a very good trade that we managed to do, even though, of course, the profit was very, very low, because we sold a put on Friday. Yeah, and here it is, the trade. So we managed to sell a put. Yeah, here it is. We sold a put on the 21st, right at the beginning of the session. We received 11 cents. And so we got 3 puts on the XLF with a 51 strike price. And then later in the day, we managed to buy those back at 1 cent. So this was an extremely profitable trade. 63% in profit is amazing, given the fact that this is a very low volatility ATF. So this is very good. And so we managed to buy these puts back, and we basically rolled over the entire position here. All right, we received 23 cents because the stock is hovering a little bit closer to the 51 strike price, even though it has increased in the meantime for the rest of the trading day. But yes, this is where we stand here in terms of the puts, and it's still good because if the stock comes to and if we are forced to buy these 300 shares of 51, we would have here 51 times 3 plus 53 and a half of the other 100 that we bought. So it gives us this value, and we divide by 4, so we would have a cost basis of 51.62. So we would be able to start selling the 52 call, and we still get the capital gain on the side, which is, of course, always positive. This one is also an interesting one because we are almost be able to buy this back. We are so, of course, given the in terms of percentage, we are very much far away from the 53.50 strike. And so this call, first of all, it was sold at a very low premium. Here it is, and we sold this on Thursday. We just received 4 cents for it, and it's almost at 1 cent at this point because, of course, it's going to be very unlikely that it reaches this strike. Currently, these 100 shares that we have on XLF Let's just take this out of the way. Let's just, yeah, just to see how much it is. Yeah, currently with the premiums, the cost basis is 52.72. So we could potentially start selling at 53. We can probably start to do that next week, but if the stock, of course, continues to hover around the 51 and a half and 52, and if we manage to do that, we can probably still do it this week, this coming week. If this is at 1 cent, we can buy it back and we can sell another one at same maturity, November 28th, but at a lower strike to still collect some premium. But this is something that we have to consider, just how the market goes and make the decisions on the spot. For the time being, I must say, of course, this is very much hindering our progress towards the end of the challenge, and it's a pain, but we must keep optimistic because if we don't need to look any further than this. Even this is a 5-year chart, of course, but we think if we can come back even further than this, the market in the long run always has been rising, and there is no reason for us to think that at some point such large indexes such as the Nasdaq will come down indefinitely and never will come back to where it once was. So yeah, we will continue to chip away, and hopefully the markets will come back to normal and we'll be able to get back into our cruise speed towards the end of the challenge. But for the meantime, this is it, and feel free to leave your comments in the comment section down below. As always, I'm also available on LinkedIn in case you need to ask me any questions, and of course feel free to like the video and subscribe to the channel, and we'll reconvene either on Monday evening or on Tuesday morning to start the week number 70 in this challenge, and I'll see you there.